Are you looking to make a play on a specific sector? We got you today with 3 sector reviews. Fellow investors, bonjour! This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement. Dividend investors, bonjour. Mike Leroux here for Dividend Stocks Rock. I hope you are doing well today. You're listening to the Dividend Guy podcast. I am with my co-host Véronique. Both feet in the snow every single day. I'm getting crazy, and you're going to hear the smile in Véronique's voice. I'm sure of that. How are you doing, Véronique?
I'm doing good, Mike. And it's been a running gag between you and I because you just hate winter and I just love it. Like last weekend, my husband and we were like, I think it's becoming our favorite season. And I was thinking about you and I was like, oh
Stop
my
it.
God.
See, ironically, last week at the very same time that you were thinking about the perfect season, I was telling one of my friends, I'm like, you know what? I'm just waiting until Caleb's going to Cégep, which is going to be in 5 years. So already I'm like looking forward for 5 years. And then I'm going to work at least a month in January, like the full month of January. I think I'm going to go to Costa Rica, work there, and come back just for his birthday in February. Because I'm just like, I'm like this close to buy myself a flamethrower and just like burn the entire snow everywhere. But anyways, maybe we should start talking about investing.
Yeah, we always agree to disagree about that one. So
There
let's
you
move
go.
on. So, Mike, the biggest struggle investors face in the current market is to find buying opportunities. Everyone is afraid of buying too high and then having to sell low. But the truth is, there are stocks worthy of our attention, and we will use 3 sectors today to give you examples and ideas.
Just to be clear, I'm not the type of person that will change his entire portfolio to make a play on a specific sector or on a specific trend. I actually advise against doing so, mostly because we never know which sector is going to thrive in the next 6 or 12 months. And when you do that, you're kind of like making a bet on short term results.
Mhm.
However, it's always great to think long term and position your portfolio, making some tweaks according to which sector or which industries you think is going to surf on a strong tailwind in the coming decade.
And before we start, remember to never consider the stock ideas we will mention today as buy or sell recommendations. Always do your due diligence. All right, let's start with a sector we often overlook, industrials. This one is seen as boring and it's filled with companies that have been around forever. So what else could describe it?
It's true. Even like the semiconductors in the technology sector now, as like I see them as the new industrials, and the old industrial, like nobody wants to think about them or talk about them. And for that specific reason, I believe it is one of the best place to start treasure hunting because there are amazing companies across this sector. It's so diversified that it is a rare place where you could have like 30, maybe 40% of your portfolio invested in that sector and you would still be well diversified. The key, of course, about sector diversification is to not be dependent on specific economic events. So if you invest and everything is around artificial intelligence, for example,
Mhm.
just using stocks that are supposed to thrive on that economic event. Well, if it's not the case, your portfolio is up for a big roller coaster. So, with the industrial sector, what is great is you can have some military stocks, you can have some consulting services or engineering firms, you have transporting companies in the trucking industry and railroads. You can have like waste management companies making tools. So a lot of things that they have in common is that most of them are like big players in specific markets. So they build a sticky business around their knowledge and their niche expertise. So by using a solid stock screener with robust metric, you can create a very long list of interesting companies.
And of course, we would not talk about this sector if we didn't believe it could bring value to one's portfolio. So, Mike, What are its greatest strengths?
One of them is a lot of those business models have very strong moat. We can think of like military, railroad, waste management. Those companies will work with long-term contract. They will benefit from economies of scale. They will also have like high quality assets such as the railroads. And many of those industrial businesses will also show stable revenue generated by repetitive purchases.
Mhm.
So you have like a good mix of like selling products and offering maintenance. Some other companies will offer subscriptions to their services as well. And of course, I mean, if you're thinking about transportation, yes, it is cyclical, but you'll always have the need to transport goods, and there's always like a basic demand for that. Industrial companies will also develop extensive expertise in niche domains, so that creates strong bond with their clients, and of course, that creates a sticky business where customers will think twice before switching with their suppliers and partners.
And what are its most significant weaknesses?
One of them that has been highlighted a few times over the past 2 decades is the fact that they tend to become too large to be managed efficiently.
Mm.
We had a perfect case with General Electric, GE, back in the financial crisis of 2008, where the company had to be split and then ran into like so many different financial problems just because it became too complex and had like branches about everything. 3M most recently, which actually ironically have been starting to do better since their spinoff. So again, they were going through a lot of problems. One of them was that they became what we could call a GDP plus type of business. So a business that is so well diversified, making money across the world, that the only way they could grow would be just to wait until the world GDP is increasing. And then whenever you hit a bump road with those kind of like business model, well, you rapidly fall into losing money and negative EPS. So they did their spinoff, they're becoming leaner, easier to manage, and it's a little bit better. Of course, with this type of size of business, we're also thinking about a larger size of debt. Those companies, most of them are capital intensive. They have to either have large manufacturers or invest massively in research and development. So again, very tough to maintain margin, especially during a case of a recession where their manufacturers are not fully utilized and then the margins are going to take a big hit. Another example would be like if you're thinking about a company like TFI International, which is a trucking company. Imagine that during a major recession, a big part of their trucking fleet is just parked and not doing anything. Well, of course, that requires a lot of maintenance fees, but it's not generating any revenue. So this type of business could easily see their earnings melt as snow during the spring.
But Mike, given their sensitivity to economic booms and recessions, how should investors approach dividend stocks in the industrial sector?
Well, their cyclicality is like kind of like a curse and a blessing at the same time. I
Hmm.
remember that back in 2016, all railroad companies were getting into a big hit, mostly because expectation for economic growth was like super slow. A lot of investors expected a recession. So that was kind of like the perfect timing to grab some railroad companies at a cheap price. Shocker alert, we're going to talk about CNR in a few minutes, but this is a good example right now where the company has not generated much returns over the past 5 years, while the stock market has skyrocketed. This one is kind of like a steady eddy, not really impressive, but whenever you feel that the market is trading at such a high value and you see those industrials that are too boring to get any love from the market, that could be a good place to start shopping.
Mm.
Another strategy could be to look for companies that are growing by acquisition in fragmented markets. There's still a lot of room to grow. Thinking about TFI International, for example, that has been their business model for ages. Whenever there is a slowdown, smaller competitors in the trucking industry will have a rough ride and then they will think about selling. So then TFI International will be able to grab those competitors, buy their roots, and increase their network at a cheaper price.
And considering the fact that everything seems overvalued, why does the industrial sector currently shows opportunities?
Well, the thing is, the overvaluation right now, or the fact that the market is trading at all-time high, is a lot driven by a few sectors. If you look at the S&P 500, now more than 30% of that index is driven by the Magnificent Seven. So if you
Mm.
take away all those richly valued tech stocks, you're starting to get a different type of landscape. Of course, when you're thinking about what you can find as opportunity in the industrial sector, well, you do have a good list. The first one, I just like mentioned it, railroads. They have not offered much returns as of late, and this is why it's probably a pretty good time to grab some shares. We're talking to patient investors in this case. So if you're buying CNR or CP or any other like US railroads operators and you expect them to grow double digit in 25, chances are you're going to be disappointed. Like those are like kind of stocks that you pile in your portfolio and then you just forget about those, and then eventually they're going to pop up as the company continue to generate earnings and revenue accordingly. Another place where I find a lot of interesting stocks these days is the infrastructure play. So infrastructure can be seen as many different industries, and this is where it gets tricky. But the overall idea is both the Canadian government and the US government intends to invest massively in their infrastructure.
Hmm.
There's a big reason there. We have like underinvestment in infrastructure for several years in North America. So now it's just time to invest a little bit more into our roads, into our buildings, and so on. So using the stock comparison tool at Dividend Stocks Rocks just make my life easy because I can pull out all the companies from a specific industry. So I can load like a pre-selection of like all the stocks in the industrial sector, and then I can narrow it down in industries that could be surfing this tailwind into investment in infrastructure, such as engineering in construction, industrial distribution, or building products and equipment.
Hmm.
One other thing is, as we can see trade tension rising up between Canada and the US. And I think that like this story is going to have like several chapters. But one thing is for sure is that it starts to stimulate the Canadian economy to invest a little bit more on our side of the border. And maybe that investing massively in infrastructure will help compensating for the job that we're going to lose that will be related to the exportation to the US. So
Hmm.
that was one of the solutions that came in January as a potential way to keep our economy growing in Canada. So definitely those businesses will benefit from an injection of funds.
So you're telling me that I'm not about to see my husband more, right?
Pretty much. It's actually, yeah, it's actually good news, right? For that.
Listeners, I hope you enjoyed the episode so far, but I have to interrupt it a minute. Our goal at Dividend Stocks Rock is to help you invest with more conviction. We know that dividend income is important for you, and this is why we have gathered all you need to know about it in the Dividend Income for Life guide. Right, Mike?
Yes, I have a completely different approach when it comes down to generate dividend income, and I wanted to share my view with that. I wrote a series of DSR fundamental newsletters that were greatly appreciated by our members this year. I received tons of comments, and a lot of them were, Mike, you just came out with some very thought provocative concepts, and at this point, I really want to change my portfolio and follow this path to a better type of dividend income. So I've did a great review of those DSR fundamentals newsletters, packaged them together, wrote a few more pages of content, and built that dividend income for life.
This guide, as you said, has been highly rated by our DSR members, and we share it for free with you today. To grab your copy, hit pause on your app, visit thedividendguideblog.com/income, and enter your name and email. You'll then receive the email with your download. And also, by the way, it's always a pleasure to hear from you, so please let us know how it helped you. Again, thedividendguideblog.com/income.
All right, so the fun part now, what would be your favorite dividend growth stocks in this sector?
You know my love for recurring revenue, so I have to start with automatic data processing, ADP. It's kind of like counterintuitive because you may be thinking, well, this company is like a payroll slash human resources business. It should be seen almost as a software business, but it is classified into the industrial segment.
Mhm.
The company is one of the largest, if not the largest, actually, payroll manager in the world. They have have this amazing moat where they've built a close relationship with their HR tools and software suite with employers. And as an employer myself, I mean, the last time I changed my payroll service provider was the first time I actually enrolled to a payroll service provider. I mean, unless they're making mistakes, right? If
Hmm.
all employees are getting paid and they get their paycheck and then I can manage my people on the same service, why would I change? And this is when you can see how sticky a business could be. And ADP just reports great earnings quarter after quarter. Going into another industry, aerospace and defense, I really like Lockheed Martin. Lockheed Martin is the maker of the F-35, so one of the largest and longest contract in the military existence ever. Again, super strong moat. I mean, who else can make fighter jets? You don't have that many competitors going after Lockheed Martin, which ensures a very solid revenue base. Another one that could be interesting if you have the heart for it, because it's a little bit more on a roller coaster, that would be AO Smith, AOS. They are a leader in North America for water heater and water treatment products, and they are expanding a lot in China and India. So thinking about all the tension between China and the US, that's going to be interesting to see how this story will evolve. But the stock price took a hit, so maybe it's time to take a second look at it and maybe see if it's a good fit for your portfolio.
Hmm.
On the Canadian side, well, transportation business should probably give you some great opportunities. My favorite ones are Canadian National Railway and TFI International, so a railroad and a trucking business. As I mentioned earlier, CNR has not done well over the past 5 years compared to the rest of the market. And whenever the company offers a yield above 2%, it's usually a good time to grab some shares. So I do have a position on this one. Never regretted it, but of course, it's all about the timing that makes an investment even better. For TFI International, when there is a recession, there's also a lot of acquisition opportunities, as I mentioned. So I think this one will probably not necessarily have like the best year of their life in 25, but will certainly be in a good position to increase and extend their network of distribution across North America. Finally, two plays on infrastructure that I have in my portfolio. I bought them about 18 months ago. Toromont Industries, so one of the largest Caterpillar dealerships. So most of the revenues are coming from Canada. And then you have a Stantec, an engineering firm that is taking care of projects from A to Z. So from the planning, the building, maintenance, and also all the way down to decommissioning and destroying the infrastructure they help building.
And Mike, you've mentioned Modi businesses in the industrial sector. So which ones among your list have the strongest economic moat?
I think on the US side, I would go for ADP, mostly because of their economies of scale and their high switching costs. Because it's not only just a matter of like a fee to transfer to another payroll and HR supplier, but also a learning process, which most companies don't have time to spend there. On the Canadian side, well, I have to go with railroads because I mean, you cannot create new ones. It would be so much more expensive.
Right.
Those roads are all like well established, and it's like one of like the super highest quality asset that we can imagine, especially to transport goods across such a large territory. So unless we invent teleportation, I think that business model is pretty safe.
All right, so let's now move to the financial services sector. This sector could be divided into four great categories: asset managers, banks, insurance, and financial data and stock exchanges. What can define it?
So let's start with asset managers. So you will have like two type of asset manager. You're going to have the asset light and the asset heavy. An asset light manager would be a company that just gather money, create funds, and then invest in those. So a good example would be BAM, Brookfield Asset Management. So they will charge a recurring fee on the assets under management. BlackRock on the US side could be seen as both an asset light and asset heavy because they also invest their own capital. So that's the difference. When you invest your own capital, you're taking additional risk, of course, because if you're losing money on an asset light business, well, that's not your problem. You may lose clients, of course, but you're not going to lose your invested capital. If you're asset heavy and you're incurring a loss on an investment, well, you do take part of like the profit or the loss. So there's a double-edged swords there. Brookfield Corporation is an asset heavy, so it invests its own capital on top of gathering other investors' capital. They will obviously follow the stock market. So whenever the sentiment is positive, they're going to thrive. And whenever the sentiment is negative, well, they will see their assets under management going down. So that means less
Mhm.
revenue and, of course, less earnings. For banks, we do have two different types of business model here. So we have like the highly protected, regulated model in Canada with about 30 companies that have a license to operate a bank and really dominated by the big five. I just love to introduce National Bank in this one, even though this podcast we're not going to talk about National Bank, but let's talk about the big six in Canada. In the US, it's completely the opposite. We have like over 2,000, I think it's 2,000 or 4,000. Anyway, it's in thousands. It's like convenience stores. Like literally,
Mhm.
we could open a bank over there as long as you have enough funds to open one branch. You're almost good to go. So very different business model. You have like very small and regional players over there and big guys as well, such as Bank of America. So the range of investment and possibilities are like quite different from one side to the other of the border. Then you have the insurance companies that could be split into life insurance and also property and commercial insurances. Of course, property and commercial are a little bit more subject to natural catastrophes, while the life insurance business has found a lot of growth over the past 2 decades into wealth management. So yes, they offer insurance products, but since those are seen as commodities, they have diversified by offering financial planning services, wealth management services, and this is where the money is. Finally, financial data and stock exchange. Well, those are the companies operating the stock markets that we know. So if you invest on the
Mhm.
TMX, for example, or if you invest on the New York Stock Exchange, those companies are listed on the stock market as well. You can participate into them, and they make a lot of money by recurring fees, of course, with IPOs, with trading, and also by offering financial information. So, for example, to run Dividend Stocks Rock, we actually paid the London Stock Exchange for their Refinitiv platform
Right.
that is similar to Bloomberg. So it's a recurring fee for us, but this is how we get most of our financial information. So it's a pretty sticky type of business.
And what are the greatest strengths of the financial services sector?
I would say that as the like for all those industries that I discussed, the best strengths here is the ability to bring a balance between a good yield and growth, especially for
Mm,
banks and life insurance companies. They offer decent yield, often above 3%, but they're still able to grow mid-single digit.
right.
For the financial data, I would say it's definitely about recurring subscriptions, and they are growing as more people invest, as we kind of like we are living in an inflationary world. So whenever assets under management are growing, asset manager will benefit from it, but also stock exchange. So those companies tend to show very solid dividend triangle as of late, a little bit more geared toward low yield, high growth type of stocks.
And what should investors be careful about?
Cyclicality, financial crisis, competition as well. So for managers is definitely they're highly dependent on the hype and the panic from the stock market. So you have to be ready for that. I mean, if you look at most of the financial asset managers, they go up, they go down like a roller coaster. They're basically just following the market. So when you buy one in your portfolio, you might as well not necessarily take a deeper look at this one and track it every week, because you're not gonna feel well after a while. For banks, I would say always track the provision for credit losses. So of course they're making a lot of money by lending to people and lending to companies, but those commercial loans and mortgages, they have to be paid back as well. So tracking provision for credit losses will avoid you a great deal of problems. And it's not because it is a great bank that it cannot fail. So you have always to remember that. For insurance businesses, they are highly subject to interest rate movements. The reason why is as they issue more life insurance policies, they get a big part of those premiums and they invest that in the market. So this is how they make money. The thing is, they want to make sure that they still have money to pay back claims. So for that reason, they have a big chunk of their investment into the bond market. So the
Mhm.
bonds will fluctuate as interest rate goes up or goes down. So that is also one of the reasons why they decided to diversify diversify their business model and move a little bit more towards wealth management. Finally, financial data and a stock exchange. While they operate kind of like an amazing business model with a sticky business, regulators are looking at them. So there is a potential where regulators will say that they cannot charge more dollars for financial information. So maybe limit their pricing power at one point. There is also a lot of competition in this field. So sometimes you're going to have like winners and losers when this happens. And of course, big guys will benefit from economies of scales. Smaller guys will be a little bit victim in this kind of story. You can think of like TMX Group on the Canadian side, which is a pretty solid player in Canada. But in the event that US stock exchange companies would enter into that market to try to compete, well, then we're going to have like a different type of landscape.
So, as you said, Mike, we often discuss Canadian banks, but this time I would like to draw your attention a bit more to stock exchanges. Why are companies like Nasdaq, S&P Global, and Moody's considered strong dividend growth candidates, and how are they different from traditional financial institutions?
Well, it's actually a key segment in the financial industry. They provide the essential infrastructure for trading and global financial markets as well. So it's kind of like the infrastructure that enables all transactions. So literally like the highways where this is the reason where we are able to open a brokerage account, buy and sell. So they provide that service. And of course, it's kind of like crucial and essential. So quite sticky as well. They also generate a lot of revenue coming from selling market data analytics. I mean, when you think about that, they are aware of every single trade that is being made every single second. So they could provide a lot of research, a lot of analytics to financial companies like Dividend Stocks Rock, but also to banks, to all institutional investors. So it's a great place to be. We're definitely at the center of that, where wealth management has become so much more important. And a lot of investors rely on their portfolio to assure their retirement. Well, they're at the center of this. So it's kind of like hard to go around those businesses and skip them. And this is the reason why, in general, they show a very, very robust financial triangle. So you will likely see a steady revenue trend because they're growing as the market is growing. And then because they have some good pricing power, their earnings per share will follow. So showing good margins at the same time. And of course, they're paying a dividend. Those dividend yield are very small, but they are increasing every year. So if you hold them for a long while, well, your yield on cost will start to become quite interesting.
Mike, are they part of your favorite picks for this sector?
Yeah, definitely. Nasdaq, S&P Global, and Moody's are like very big guys on the US. They benefit from like a very high reputation as well, which is super important when you're selling research and data analytics. And I would also add on the Canadian side X.to, so the TMX group, which has been able to grow quite fast over the past 5 years. Very impressed by their dividend triangle. So I do not own any of those, but definitely would be a place where you can find a lot of interesting candidates for a growth portfolio.
Okay, so I believe I've kept the most interesting story this year for the end. Recently, enthusiasm for utilities, especially renewables, has grown again. Let's first give an overview of the sector.
Yeah, it's kind of ironic how utilities and renewables are getting into favors and not getting into favors of investors, like depending on the
Hmm.
quarter you look at. So going a little bit more towards renewables for this episode, there's always like a mixed feelings about them, and I found it just fascinating. There was a huge interest after COVID and up until 2021. Well, all renewable companies just skyrocketed. It was just that you just need to talk about like wind or solar panels, and then there you go, boom, your stock price will grow double digit in a heartbeat. And then everything crashed, leaving all those renewable stocks with not much. So a lot of investors thought, well, they still rely on subsidies, but this is the energy of the future, so let's just jump on them. And then as the money was moving over renewables, we saw the good old oil and gas sector like pumping up more oil than ever making a lot more money and a huge comeback after the debacle of 2020. So rapidly, we saw the money going back to classic energy sources. And then it remained not really interesting for several years. And then in 2024, we started to see a glimpse of hope. Some stocks started to go back up. And then after the election, the hype faded again. So there's a lot of roller coaster stories here. You have to
Hmm.
be very patient. And if you're not a patient investor, well, maybe you should reconsider your investing strategy because you always need a little bit of patience. But you can skip this part of the podcast because I don't believe that renewable energy stock will skyrocket in the next 12 months.
Hmm.
But I think it's important to have them for the long run.
And what are its main strengths and weaknesses, Mike?
In the strange side, well, a lot of those operate in an unregulated environment. So that means more competition, but also means more profit down the road for the ones that are able to manage their assets properly. There is also a very high demand and a growing demand for energy. A lot of investments are being made, especially by the technology sector. And we're going to talk about that in a second. But since it's a legitimate source of energy, there's a lot of demand. And even like nuclear is getting more and more interesting in that regard.
Mhm.
So we can see the potential for another hype. You always have to be careful with those. But at the same time, I'd say that the strongest companies in that sector will definitely make investors happy. Of course, there are a lot of weaknesses. The first one, I would say that a lot of those contracts and a lot of those projects are still dependent on government subsidies. So if the government is not there to help because it's highly capital intensive and while the technology is improving and it's getting cheaper and cheaper, it's still difficult to compete with fossil fuels and other classic type of energy. So you're still able to generate energy from coal at a cheaper price sometimes. So that creates a sense where if you want to invest in a highly profitable business, maybe renewable energy stock is not the place that you're going to get the money for your buck today. But over the long run, that could definitely change. So you can see how volatile this subsector will become for the coming years.
Okay, so let's now address the elephant in the room. Recently, big tech stocks have invested in renewable companies. An example is the contract signed between Microsoft and Brookfield Renewables. What is it all about?
Well, there's a lot of fuss about this because there's a lot of fuss about artificial intelligence. But the thing
Hmm.
with AI is it requires a huge load of energy to be processed. So, a lot of computing power and then a lot of energy. And of course, technology companies, they want to have like that good conscience that comes with investing in renewable energy. So there is a huge demand for that. We have seen also nuclear companies that are going like skyrocketing just because like the market believe it's going to be the energy of the future. Again, tread carefully when you're trying to go with something that is going to be the next stock of the future because you never know how it's going to end. And that is like one key element that could make a lot of profit in your portfolio, but could also sink a part of it. So just make sure that you're still well diversified and you don't move like 35% of your portfolio into renewable stocks after this episode.
But Mike, some tech stocks dropped about 17% at the end of January in a single day due to a new AI player. What was the story, and does it also put utilities in trouble?
That created like a big commotion at the end of January when DeepSeek, another equivalent of like ChatGPT or Gemini, but the difference with DeepSeek is they're doing about exactly the same thing. Well, that's the claim at that point when the news came in, but it was built on a cheaper technology and required less energy. So, in other words, very bad for the massive investment in infrastructure, like to help semiconductors to create more high tech chips that will not necessarily be useful right away. On that day, we actually saw Capital Power CPX drop by about 17% as well. The drop was as big as for Nvidia and Broadcom than it was for some
Hmm.
renewable energy companies. Some others, they didn't take that much of a hit, but like a 5-6% hit as well. Mostly because we're thinking, well, if the demand for energy is less, yes, they're going to still be around and produce power, but they might not be able to sign those lucrative contracts with the big tech guys.
And with all that in mind, what would be your favorite stocks for this sector?
I would go for a little bit more of safety here. So NextEra Energy, NEE, which is one of the largest green energy producer in the US. They
Mhm.
generate the bulk of their income from Florida through Florida Power and Light (FPL). Flourishing state, very stable economy, so a lot of growth potential over there. And of course, management in their investors presentation, they explained that there's a lot of need for energy from big data centers, and also the electrification of a lot of like manufacturing. Oil and gas industry will require as well more energy. So they are well positioned to benefit from those tailwinds. Another one that I find very interesting is Xcel Energy, XEL, mostly because they are a classic utility distributing like electric and natural gas to a lot of clients, but they are present in 8 different states. And what they do is they use each state's geographic strength to benefit from more renewable energy. So, for example, they will benefit from a strong wind energy from states like Minnesota and North and South Dakota, while they get more solar power from Texas and New Mexico. On the Canadian side, well, I'll go with the classic Brookfield Renewable, one of the largest player over there, but also one of the rare player that is constantly reporting funds from operation growth and increasing its dividend year over year. So I like their diversification. I like the fact that they have about half of their power being generated by hydroelectricity, which is a little bit more stable than wind energy, for example. The next one that I like as well is Hydro One, based in Ontario, almost held by 50% by the government of Ontario. Very stable, benefiting from the economy of that province as well diversified. So not too worried about the potential recession over there. And they show a very steady dividend triangle. So the revenue, the earnings, and the dividend, they are increasing clockwork. It's quite impressive.
All right, Mike. So let's end with a quick note on sector allocation. How should dividend growth investors decide the optimal portfolio allocation?
That's a tricky question because I believe there are great opportunities in every of the 11 sectors. So, where do
Mhm.
you go from there? Well, start with sectors that you understand best. The reason is quite simple. It will help you draft your investment thesis, it will help you understand business models and strategies a lot better. I mean, if you're not understanding how banks are playing around with their provision for credit losses and how there is like a complete playbook around this,
Mhm.
well, then you're going to feel uncomfortable in thinking that maybe a bank will go bankrupt because their provision for credit losses increased too fast. Understanding the sector will also help you understand what's happening when a company and the stock is down. So you understand why it's coming from. You also understand the strategies to get out of this trouble. So, in overall, it will help with your conviction and your confidence in your strategy. Personally, I don't like to have more than 20% into one sector, mostly because I don't want to be exposed to one single market event that could crush my portfolio. I mean, again, that's more like a guideline than a hard rule. It happens several times that I see one of my favorite sector going up to like 22 or 25%. Not the end of the world, but it's just like one red flag when I analyze my portfolio. I'm just thinking, well, maybe I should trim this one a little bit. So I don't necessarily have a specific amount of sectors in my portfolio or a specific percentage per sector. I rather go for companies that I love, but at one point, what's going to happen when I search for the next stock to add to my portfolio, I'm going to avoid on purpose companies that would come up from a stock screener research that would be in a sector that I already have like 4 or 5 companies. So the
Mhm.
key here is not to buy more of the same, buying like the same companies with the same business model, because you're not adding to the diversification, but you're adding to the time that you need to monitor those companies. So I rather invest in companies in different industries so that they will be in a better position to add something to the mix and make my portfolio better for the long run.
Well, thanks a lot, Mike, for sharing places to dig for great stock buy opportunities. Listeners, to better understand how we analyze companies and why we select them, download your free dividend income for life guide at thedividendguideblog.com/income now. For the show notes and related content, visit thedividendguideblog.com/215. Next week, we would like to know if we should invest like billionaires. Hit the subscribe button underneath our podcast logo now to avoid missing it. And Valentine's Day is coming, so you might as well show us some love with a 5-star rating. Until next week, stay invested.
Stay invested. Hey fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guy blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.